Apart from team, of course, we look at traction, technology, target market, so all the definite five P's of investing we look at. Team is the most important factor for us. What we're looking inside a team is primarily the pedigree of the founder, the background in which he or she has come from, and also how closely they relate to the problem they're trying to solve. They've been a part of the same problem that they're trying to solve, or have experienced that in some shape, form, or the other. So for us,
Hello, everyone. Welcome to the Creek Show funding series presented by Creek, your go to platform where hustlers learn, connect, and interact with each other to scale their startup ideas. This is your host, Akshita, and today we have on our show Aditya Arora. We will talk about the right timing for the fundraise, red flags in the term sheet, effective networking, common mistakes founders make, etc. Aditya is the CEO of FAD Network, notable angel investor, a successful young entrepreneur, mentor at several startups and government bodies. He is also the recipient of Parliamentary Award and nominee of the very prestigious Padma Shri Award. His portfolio includes around 20 startups like Clear Dekho, Nature's Tattva, Nine Unicorns, etc., to name a few. By now, I'm sure it is clear that he is no ordinary millennial and has a drive to make a difference. Let's dive right in. Hello, Aditya. Welcome to the Creek Show. It's a delight to have you here. We are so excited to get to know from you all the insights about the industry, about the startup ecosystem.
thanks a lot, Akshata, and thanks a lot, Team Creek, for having me. It's a pleasure to be here and look forward to the interaction.
Pleasure is ours. So let's dive right in. Tell us about how you go about investing. What are some of the things that you look for in an entrepreneur or their idea and startup?
So, just to give you some context, we invest at early stages, right? Which are generally the seed and the angel rounds of a company. In those particular transactions, the pedigree of the whole deal is very different because you are looking at a company which is, let's say, just 1.5 years old with probably no track record at all, with with sometimes even no revenue in pocket. So you're looking at companies which are very early. So how we evaluate them also becomes very different. So we're not looking for companies with the best of numbers. We're not looking for companies, let's say, with the best technology, because we know at this stage, at an early stage, nothing is perfect from day zero, right? You eventually grow, you raise capital, you invest that capital to try to move towards perfection. So we look at more than that, we look at the pedigree of the founders as our most important factor. Apart from team, of course, we look at traction, technology, target market. So all the definite five P's of investing we look at. The team is the most important factor for us. What we are looking inside a team is primarily the pedigree of the founder, the background in which he or she has come from, and also how closely they relate to the problem they're trying to solve. They've been a part of the same problem that they're trying to solve, or have experienced that in some shape, form, or the other. So for us, it's very important to see that there's a founders market fit, right? The founders are there in the right market. They're running the right startup. They have the right kind of energy to run. Secondly, what we look at is what's the culture that the team is trying to create. I know it's a very underserved and a very overlooked factor, but culture is as much important to the growth of a startup as are its technology and numbers. Right? Because if people are not motivated to come to the office every day, then how would a startup eventually go on and make returns for investors? So that is what we look at. And lastly, we look at the vision, right? So if let's say the current picture is something which is not very pleasing to the investors, but what would be the picture 2.5 or 3 years down the line? Right? What's the kind of scale that you want to expand? What's the kind of vision you have, right? Because if you're not having the right kind of vision, you're running in a road in which there is no direction, right? You're running aimlessly. These are the primary set of factors that we try and look at. Team being the most important one, followed by others.
Right, because primarily when you do not have the product, the right team should be in place to advance the growth of the product, because that kind of dictates how the startup will grow in the future. Right. So when we talk about early stage startups, do you also invest in paper state startups?
So we used to look at paper stage. In fact, the whole investment ecosystem was investing in paper stage startups in 2015, right?
Yes.
But now, of course, as you know, that angel investing has been there in India for a while, and investors are becoming more wise in their decisions. They are getting access to more market information that is out there. Um, Data has also become much more filtered and curated these days. So investors are taking much more wise, informed, and calculated decisions. Paper state, see, the problem with paper state startups is two things. One, we don't know whether it will work or not. The second problem, even if it works, we don't know that someone may go ahead and execute that before they do. So they may become late in their execution. So that's the problem with paper state startups. You never know in which direction it will go. And now, since investors have become more wise, they've got access to much better deals right now. Right? So, of course, paper stage is something which, or napkin stage is something which we have crossed now, not investing actively in them. But we look at them from a completely different point. We don't look at them from an angel perspective investment. We look at them more from a hand holding support, wherein we can get them under our cohort and we can mentor them and guide them towards the path of fundraising. So not ready to raise funds right now. And then, let's say at this moment, you wait for 2 or 3 months, you try and become much more mature, and that's when you try and raise capital. So that's the path we want to follow with Paper Stage. Not giving them access to angel investors on day one, but taking them through that path so that they are ready whenever they are pitching in front of angel investors.
So the bottom line being not letting a good idea go to waste, providing them support in some way.
Absolutely. So yeah, you should, whenever you find a good entrepreneur, whenever you find a good concept out there, try and support that from your end, even if it, let's say, not an immediate help. Track them or just notice them around, and someday or the other they'll come back, because fundraising is a continuous process.
Right.
You may not even end up investing at idea stage, but the help that you do, let's say you bring in a mentor or you bring in an idea stage incubator, accelerator, or investor, they may end up coming back to you, right? When they're raising their seed or when they're raising their angel.
So, what is the right time for founders to approach you for funding? What are the milestones that you look for while funding a startup? Is it having built a core team already, onboarding the advisors, gaining enough traction?
So for us, see, two questions. One is, the right time to raise funding is at a point where you have certain validation that this thing actually works, right? Either in the form of, let's say, good reviews, either in the form of customers buying it, sales, which is the best form of validation, either in the form of good technology, anything, right? Validation is very subjective. So anything which, of course, you think is getting acceptance in the market, there are early adopters for that product or service. You are trying to raise angel money just to expedite this whole process, where you can put more money behind marketing, behind technology, behind product development, and hire a few people off the ground. That's one of the ideal stages when that matches to happen, right? And more than that, you have that drive. Now coming to the second question, which is, what are the milestones we look at? So from an investor perspective as well, what we are looking at is a plan as a dry powder. What's the dry powder for the next 3 years? Are all the checks in places, right? Let's say even if we can't get Starbucks right now, but do we as a client, right? But do we have that product quality, or do we have that plan figure out that if, let's say, our product goes to this level, we'll get them on board? That's what we're trying to look at. It. What's the business plan that you have for the next 3 years? How do you want to grow actually?
So
And
I
how
think,
convinced are you on your plan? Yeah.
I think, like you mentioned before, like having a direction is what is important, that you're not wandering around. You at least have a sense of direction, that where you're headed. Right.
Absolutely, because that decides everything, right? Even if, let's say, you end up raising a crore, you know that where will I put in capital, and where all you'll put in capital ultimately is driven by the direction decisions that you want to go.
Right.
The plan should be clear. We are looking for visionary founders who have at least that vision, and more than that, the confidence to execute.
Right. So Aditya, you have a portfolio which comprises around 20 startups. As a mentor and board member of several startups and being in the ecosystem for so many years, what mistakes do you think that founders often make, which in the longer run lead to the shutdowns?
There are plenty of mistakes. I think founders at early stages make plenty of mistakes more than they do the right things.
Hmm.
And so the mistakes end up, as you said, end up eventually becoming the decision of a startup actually becoming a unicorn to its shutting down. Some of the decisions it initially at idea stages may not look like they are bad decisions, right? They may look like they're very tiny mini decisions. Once you go ahead, you become a big company. That's when you utilize that. Okay, this is something we should have done prior. I think the first thing is that founders end up just trying to raise more amounts of capital, and they're happy to trade off more amounts of capital for lesser quality of investors. I think that's the first mistake that they do, because it's been times immemorial. It's been proven in the past that capital just does not alone prove to be the successful metric in the startup. There are plenty of other metrics, and more than capital in early stages, you need that advice, you need that value capital, along with the crore check, right? So you want that as well. So don't trade more amounts of money for lesser quality of investors. Get as high as quality of investors you can get to the table, because everyone adds in their own direction. Secondly, what founders do wrong is that once they've closed that funding round, they don't interact with investors as much, right? And I think that's where they go wrong. They send their standard MIS reports and everything, which is a part of the information rights. They don't actually go ahead and interact with investors that much. They don't do like a screening analysis of that investor, that how he or she can help me to grow in different dimensions and whatever. I think if that is done, there are n number of other potentials and opportunities which open up for a startup, right? That is again one mistake that I think we should do. Keep everyone in loop that you eventually do, but more than that, actually talk to the investor who's put in the check in the company. See how he or she can help actually, more than the check, right? Reach out and uh, be very transparent in admitting your mistakes, right? Founders, the third thing they do wrong is they always early stage founders try to be perfect. They don't want investors to feel that there's something wrong with it, or maybe there is something which is failure, which acted as a failure. I think if you do that, then you are more than just being dishonest to the investor. You are being dishonest to yourself, which is very risky, and which is very bad on humility grounds as well. So you should be honest, transparent, admit your mistakes, and be very open with your investors. Keep your customers closer, your investors close as well. That's how I think it's the winning formula to go at. So there are two, three mistakes that I primarily see when founders. And last mistake, I think that just keep popped up in my mind was that founders sometimes think that their ventures are eventually a cash machine. Right? They would raise this amount of funding, close this round, and they would eventually go in the market and raise that. I think that is something you do wrong. Even if you end up being successful in it, you're not actually creating a whole lot of value, right? You're just being a cash money, and you're just having your own pockets full, right? And your investors' pocket full, which is not bad, but I think that is not the purpose of entrepreneurship. Entrepreneurship for me is actually value creation and solving a real problem.
Right.
Right. Cash is just a means to an end, but not the end itself.
Right.
So don't just be out there raising funds constantly. You're not an investment manager. You're a founder, for God's sake, right? So go ahead and actually prove that this thing works. Scale it up. Solve more problems. Understand your customer better as well, right? Listen to what your customer is trying to say, and then make conscious decisions and stand on them. That's the way.
Right. So, like you said, constant exchange of information between investors and founders is a good prerequisite for success. If not a prerequisite, something which adds in terms of the direction and the shape that the startup takes up. Right. So, Aditya, legal terms in fundraise are often very difficult and unknown for first-time founders. They can be really overwhelming. There are several rights of an investor as well as clauses in the term sheets. What are some of the crucial clauses and the red flags that founders should keep an eye out for so that they are not wronged?
I think this all becomes a part of the financial knowledge, right? Financial literacy. And I think financial literacy in our country is still growing, still not at par. So there are a lot of rights which investors, even founders, they don't know to what extent they're actually signing, right? The document that they're signing. which is not a very wise decision. So, couple of things. One is, of course, you would want to know that what's the board composition, right, of your investment post this round. Who would all form a part of the board? You don't want to have a lot of people in the board, right? You want to have the people, like strategic people who can add that value. You're leading that transaction.
Hmm.
See who all are forming part of the board. Who all are your advisors whom you are shelling out equity or non-equity to, right? That is one thing. Secondly, see that investor that you are onboarding, what are the different kind of follow-on rights that they have. Let's say they'll try and put in more capital in the coming rounds, right? So what would be their liquidation what would be their amounts that they'll invest in, right? Will they double down? Will they invest, let's say, 100% more? Will they double it, triple it, whatever it would be, right? Understand what would be like the investor mindset, because that will eventually end up deciding that what's the equity that the incoming investor of this round and the existing investor will also get, right? That is the second thing. Thirdly, as a founder, you should look at that what are the vesting rights you have, right? Tell how much amount your equity is actually locked, right? What are the ESOPs that you will give to your employees as well in the company? Look at them, and these are the 3 4 standard clauses. More than that, uh, the last thing that I would say is at the time of exits, the most important clause, right, which is liquidation preference. What would be the money that the existing investors would get at the time of exit? Will it be the 2 times of their investment amount? Whatever exit returns that they want to get it, at the end of the liquidation, whenever the liquidation event would happen. So have a look at all of that, and then like also see, try to get it at 1x, right? Whatever they'll invest in, they'll try and get a return on that. If let's say company does bad, they also take the hit. So it's not like they get 2x of their amount, right? They get 3x of their amount. That is something which is very, very unfair to the founders, right?
Hmm.
Understand all of this, and there are plenty of other clauses that I can go on and explain more. But these are top 3 and 4 things that I think that you should
Yeah.
look at when you are looking at a term sheet.
Right. So a lot of companies like Let's Venture are helping in making a solid, capital table, which is attractive for investors. So I'd like to know your opinion on what the perfect capital table looks like from an investor's perspective.
For see, perfect capitalization table again is something which is it's a very negotiation based, right? Cap table all end up becoming a very negotiation based. It's not something which is written in silver lining, right? This is the cap table which you can have. You can dilute more, you can dilute less, whatever. In early stages, however, we see that 15 to 20% is the ideal dilution. Dilution should not exceed 20% in the initial rounds. To try and ensure that the 20% is with the investors in early stages, right? Not beyond that. Because then you'll also end up creating an ESOP pool, right, for your employees.
Right.
So which would again be a sort of 8 to 10% is your standard ESOP pool, which you'll go ahead and give to investors. So every time, let's say by the time you hit Series A, you would not want that founders are not the majority owners in the company, which are below that 51%. And eventually, we would want that founders have enough skin in the game so they can carry on and have more skin in the game, can carry for longer periods of time. So look at that how you will manage your ownership as well. You don't want to give away more than 51% of the company to investors and external shareholders. Try and work around that. That's the math that you want to do, and more than that, try and ensure that don't have too many people on your cap table, right? Try and see that people who have that value, who can issue larger checks, push them towards larger checks so that the compliance part also becomes very, very easy.
Hmm.
That's the
Right. So the next question is something particularly I find very interesting, and that is about networking. So you boast a very strong network of, venture capitals, HNIs, which you've built from scratch, from grassroots level. And what would you advise founders on how to network effectively? How can founders create a strong network, which includes all the people essential to the growth of their startup as well as their own professional growth?
No, essentially, see, networking is very, very important because you would want to, let's say, have a conversation with someone who's been there, done that, right? Because that makes the whole day very, very easy. So networking is something which is a very under served skill, but something which you should actively focus on. Because if you're becoming good networker, you're actually becoming good people's person as well, which eventually helps up in driving your own internal team as well. So it's all interlinked. And to become a good networker, I think what people do, like the biggest sin that they make in networking is that they just go in and exchange business cards, right? Which is probably not the thing that to do, right? Because you're trying to connect with the person, not with the business card, right? So eventually see that how you can connect with the human being inside them, rather than seeking for help just on the first go. Try and see that what is the help that you can do with that person.
You can get right.
Because if you can help someone, then eventually getting help from that other person becomes second nature. They would eventually come up and say, "Do let us know if there's anything I can do also." So figure out that what are the points that you can create. Try and connect with the person. Be very transparent. I think what people do networking, how do like people do networking wrong is because they make it a very jazzy process, right? They make it look like
Yeah.
it's very cliche and it's very like
Right.
something which is very westernized, right? But I think more than that, networking is just exchanging in thoughts and meeting with
It
new
doesn't
people.
have to be people in suits wearing expensive watches talking to each other. It can be just you being yourself and talking.
Absolutely, absolutely. And I think that now you said that, that reminds me of this movie called Pursuit of Happiness, right?
Yeah.
Wherein, of course, that Will Smith comes in pants and, of course, half pants and say that, okay, here I am, and if you want to hire me, right? So, of course, networking is not just about fancy suits. So, look at that how, of course, you can derive value more than just exchanging contact. Even if, let's say, that person is not of immediate contact to you, right? Do keep in touch, do stay in touch, and of course, you would definitely somewhere down the line you would need that help, and even if that person does not directly help you, also ensure that person also has their own network, right? So it's a network of network in that ways, right? So eventually, um, uh, that person would eventually help you in coming months, or even if any time in coming life, and even if it doesn't, it's a good human contact. Networking from that perspective, and I think if you start looking at that, and creating something which is very very valuable.
Right. And how do you generally go about networking? What do you find more effective? Virtual networking or in-person networking? Because I'm sure like these days people network on LinkedIn, but at least for me so far, it hasn't been something which has brought in a lot of results, because after all, it's still you sending a request to somebody who you've never actually met. You don't have time to make that deeper human connection.
Absolutely. No, so physical meetings and physical touch is something which is very sacrosanct, right? And that is something which no technology would be able to replace, right? Going out for coffees and meeting someone in person, seeing that person face to face. It's a different feeling altogether. Rather than just networking over technology and just seeing the other person from a very small window, right? So, of course, that is there. But and of course, I would prefer physical networking over virtual networking any day. And how I go about networking is again the similar things that I shared. I just don't go ahead and exchange business cards.
Business
I
cards.
interact with the person. I try to know who or he or she's from, what's been their background till now, what's their passion, right? And that is something which comes to me naturally. Because when I was starting to intern in FARD, my first job was to interact with people and do nothing, just interact with people and write their stories, right? So I think that has added a lot to how I go about networking, wherein I might try and become a much more people person than just exchanging cards for 2 minutes and just making it more like speed dating, right? Exchanging cards and just going to the next person.
Right.
So yeah, I'm not like that, but I love connecting.
Right. So FAD is an active investment firm in India. You know, in the Indian startup ecosystem, it's pretty notable. So I'm sure, just like any investor, you would have missed or let go of some great opportunities as well. So could you tell us more about your experience with such opportunities in this aspect, and what did you learn out of it?
Uh, Again, that's a very good question, to be honest. And there is this rule in our venture industry, which we jokingly say that you can't have FOMO in this industry.
Right.
Can't have that fear of missing out
Yeah.
because capital is limited, right? There are plenty of good startups which are out there which are really creating a value add. and we know that they'll make good amounts of money, they'll get good returns. But eventually, of course, cash is limited, bandwidth is sometimes limited as well, because at FAR as well, it's a very small team that we have. Literally, three people
Three
in the core
people.
team who are running the show, right?
Mhm.
And sometimes bandwidth also becomes an issue because we can't just invest in every startup which comes to us, and we have to select a few to take to our investors, because if we start sending all of our startups that comes to us, it also takes away the whole purpose of
Hmm.
investors investing through us, right?
Mhm.
So that ways, yeah, there've been plenty of opportunities. I think if I start curating, getting the names in my head, then the list would go on and on. But we feel happy as in, to be very honest, there are plenty of opportunities which we've missed out in terms of putting our own personal money as well. But we feel happy when we see them grow, because eventually it all helps in getting more deals or getting more startups from that particular space, right? Let's say Paytm wasn't a very, like, financial services, not a very big. Paytm made it big, and then you saw a
Hmm.
whole bunch of startups
Right.
which came up in fintech, right?
Hmm.
So eventually that opens up the whole sector, any success story, and that gets more people to get motivated and start their own enterprise. That's what we're looking at. But again, as I said, the line that I said, that you can't have FOMO in this industry.
Mhm.
Never have that FOMO. You get plenty of hits and misses. So
Right. Right. So coming to the last question, as closing thoughts, how do you see the Indian startup ecosystem flourishing? Are there still a lot of untapped opportunities? What industries are you personally looking at investing in the next 5 years? Although I know that your preference is usually agnostic, but still.
I think to answer your first question first. So I think the Indian market is still a growing market. I would not say that it's a very developed market for startups. But definitely it's going towards a much more mature market from where it started, and we've come a long way. So we should pat ourselves on the back for that. I think still there's a long, long way to go in terms of getting more innovative startups as well from India, real-time innovation happening, and startups also creating real value at than just chasing valuations, I think. So that is something which we still need in India. People building that value on ground rather than value on paper, right?
Hmm, hmm, hmm.
So that is there. And from an investor perspective, I think angel investors is such a beautiful concept. If you really want to do it with full dedication, because a, you get to work with exciting companies. It's a
Right.
high adrenaline rush kind of a setup. You don't get to have that sort of opportunity in any
Hmm,
financial investment. Actually, you invest in Reliance stocks, you invest in gold, you invest in mutual funds, you invest in ETFs, whatever you invest in, you don't get this
hmm,
opportunity to work with founders directly and solve problems which are out there for the world, not just for that
hmm.
company. So I think it's a very, very invigorating and very, very challenging role at the
Very
same time.
fulfilling.
Very fulfilling, yeah. Very, very fulfilling, yeah.
Hmm,
That is something that I want. It's very, very fulfilling, satisfying at the end of the day.
hmm,
So you need more angel investors to come up because the kind of ratio we have from startups, about 1 lakh plus startups and just 1,500 odd investors in India. I think the ratio is very, very unfavorable to startups. So
right.
more investors should come up, put in their capital, early stage capital, and at FAR as well, we're trying to sort of solve that problem in our own ways. We are a startup ourselves, we're not the investors, right?
Hmm,
So we say we are startups ourselves trying to solve a real problem. So yeah, more people should come up, and at the synergies of founders and startups, I think the government should also play a major, major role in having policies which are much bent towards innovation, which reward innovation in the right
hmm,
manner also,
hmm.
and also which makes the whole compliance and paperwork process very easy for investors
Right.
when they want to set up anything. I think if that is coming there, we'll have a beautiful
Hmm.
ecosystem which will be flourishing, and we are on the way towards that. Absolutely.
Right. So, but like you said that there are about 1 lakh startups coming up. So, doesn't that also imply that at least for me these days, whatever idea I think of, there is some startup working around that. So, despite that being the scenario, are there still a lot of untapped opportunities?
Definitely. I think it's like a deep well, right? The more deeper you go, you realize that there are a lot of untapped opportunities.
Right.
No one even knew cryptocurrency as a segment 5 years before. No one even knew nanoscience, nanotechnology as a segment 6 to 7 years down the line. No one knew that gaming would become this big and there would be people who will be making quality startups out of gaming.
Such
So
as
the
Nazara Tech, the kind of subscription
Nazara's
it had.
IPO getting 175 times over.
175, right?
So you did not know that all these things would come up. You now today you read about Discord, which is a community which just came up in lockdown itself. Microsoft is in talks to acquire Discord at 10 billion USD. So there's still a lot of untapped opportunities. I think the world is too big. You also realize that as the world is getting mature, there are more problems which are coming up. There are more high-level problems which are coming up. Right? No one was talking about data privacy until, of course, Signal came up and WhatsApp changed its policy.
Right.
And Signal became such a big thing in just a couple of weeks of time. Although the funny thing about it is that Brian Acton is the founder of both WhatsApp and Signal. So that's there. But so many untapped opportunities, I think, Akshata, which can come up. So many new problems to solve, new markets to expand into. And even if you don't get new problems, startups are not just about getting new unique ideas. Nothing is unique in this world, but it's all about how you better solve it as well, right? Sometimes the process with which you solve it also becomes very, very crucial. Just to give you an example, let's say Uber was not the first cab company in the world. Cabs running before Uber as well.
Meru
What
is
Uber,
there.
yeah, Meru was there. There were plenty, whole bunch of unorganized sector which was out there running cabs on their own.
Exactly.
But Uber, what came in, it's tried to organize that wherein it became a low asset model and also gave a location based pickup as the real value. So you don't have to walk to the taxi stand to get your taxi, right? And that was the way. So problem was the same, like they did not invent new cars to solve that problem, but just that they try to solve that from a different perspective.
Right.
So that whole new narratives, it's all about storytelling as well, right? So that whole new narratives and the ways with which you tell that story would come up.
Right. Along with the
Plenty of
timing.
opportunities, I think.
Along with the timing, I think there was this very interesting article that I read that Yahoo was before time, and then Gmail hit it right there, where hit the bullseye. So that's also a big factor.
And timing is so important because Yahoo got an acquisition offer as well from Google and Microsoft as well, but that did not work out well. So timing is very, very important for everything. But about timing, I think this is the best time to be an entrepreneur, right?
Right. Okay. Thank you so much, Aditya, for being on the show. It was such a pleasure to talk to you and to have, insights from somebody who's an industry expert such as yourself. Thank you so much.
Thanks a lot, Akshata, for having me. And thank you so much to all the listeners. Look forward to more such interactions.
Right.